Learning is the key to successful investing, and who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at Learn, Grow, Invest.
So before the pandemic, I remember that the financial stocks were a big part of my portfolio, right? And probably all the names that you're thinking about or know about. And I remember when the pandemic happened and I started to see those stocks going down, I was very concerned. And then I was like, okay, cool, just give it some time. This is gonna recover. And then I waited, and then 6 months passed, and then 9 months passed, and we're at the end of 2020. And I was like, there's this one very key one in my portfolio that I was watching. You're probably all, guessing which one it is. And so 2021 started, and I'm waiting, and I'm like, well, this must recover this year because my average price was very high. And so about July or August of 2021, I said, you know what, this is not going to happen the way that I'm expecting. And I started to, take a step back and look at everything from a higher level. And then I realized that, it's not going to, go the way that I'm expecting. And I may need to start looking at things a bit differently. And then I started to make some changes, right? And it's been, so that was 2021. That was almost 4 years ago, right? Because June, July 2021 was when I started to really tie what was happening with the financial stocks, what was happening in terms of the overall market. Because if you notice, the overall market has actually been down as well over the last couple of years. We saw a report recently where it says the JSE experienced 3% growth for 2024, right? 3%, and I think the 2 years before they experienced a loss. I don't think I'd remember how to find that article now, but the point is I noticed that the recovery of the financial stocks were still not there yet, right? And we saw what happened with interest rates. We saw what happened with in terms of just how the market was responding in terms of IPOs coming out, etc. So I think all of that is connected, right? And then now I saw this article that was shared, the article that I'm going to go through tonight, and then I'll talk about, why now in 2025 I'm so concerned about the financial stocks, why I still don't have any in my portfolio, and if I were to add any, maybe I'll talk about, I guess, which one I would add if I were to add one, but it really depends, right? Because I'm looking for some very key things before I do that. So that's what we're going to talk about tonight. Hope everybody's doing well, and let's just get right into it. So as usual, I'm going to say if you have any questions for me, you want to post them in the comments. I'm going to take questions after I go through the article. That's the best way to do it. So feel free to post them, whether you're on IG, LinkedIn, or YouTube. I post them and I'll get through them. And I'm going to take as many as I can. And if I have enough time, I'm going to go live over our community group as well. So let's get started. So the article in question here that I saw today, and I was like, that really made me remember, because a few weeks ago I was gonna do this video, and I was like, well, I don't know if I want to cover all the financial stocks. That may take a lot of time to talk about, all of them in one episode. But I saw this, and I don't think I could ignore it because it was very glaring, and this is, yeah, a big deal, right? So let me just say this first, right? JN Financial is not a listed company, but they are a financial institution, right? So JN Fund Managers is one of the brokers and the JN Financial Group as a whole, it's not listed, but the reason why this particular thing, along with others, I think is important, because what impacts one is going to impact all. And I'll talk about really how some of the companies haven't really recovered from to their pre-pandemic levels, right? So we see that with even companies like NCB, where they are back on the path of profitability, but not to where they were, 2019. All right. So let's start with this one, and then we'll see where we end up, of course. All right. So this came out today, as at the date of this video here, February 7th, and this was written by Stephen Jackson, right? JN Financial Inc.'s $2.5 billion loss, third year in red. Okay. So it says JN Financial Group Limited is offloading assets amid its third straight year of losses, right? And this first part, of course, grabbed my attention. We've seen where there's some NCB, I believe, would have started to for example, sell some of their assets. We've seen just it's almost like there is this great anticipation on one side, where everybody is kind of expecting the financial stocks to start doing well. It's in pension funds, it's in a lot of unit trust, equity funds, etc. And then on the other side, persons are like, well, maybe it's not going to go back to where it was before. Maybe it's not going to be what it once was before. And so I've seen kind of both sides, right? We'll talk about where I am later, right? So let's get back to this. So it says the group, known as the largest mortgage lender in Jamaica, sold a bulk of JN Bank UK last September for a loss. It also struck a deal last year to sell JN General Insurance Company Limited, and now plans to shed JN Fund Managers Limited, right? So again, this is why again, this kind of stood out to me, because JN Fund Managers, of course, that's a broker that some of you may use. Let me know if you use JN Fund Managers as a broker. I'm interested to see that, right? So it says negotiations are in train for those divestments. So I would be interested to see if one of the other brokers purchase JN Fund Managers, and if so, who would be the broker? Because of course, JN, I'm not sure of their customer base or their market share. I imagine JN itself, the bank, has a lot of, like, I don't think I've ever met someone who has not had a JN account, meaning older than a certain age, I'd probably say, right? Because JN has been around for a long time. So I imagine JN Fund Managers may have a certain amount of clients, but I know that the bigger brokers would be like the NCB, the JMMBs, etc., right? But if this were to be acquired, if JN Fund Managers were to be acquired by another broker, that of course would allow them to increase their market share. It may make them certainly more competitive in the space. I would love to see. I have in mind a company that I think it would be good for them to sell to, but I won't. Let's see what happens to that for now, right? So an agreement was signed for the purchase of shares in JNGI from the company by British Caribbean Insurance Company. Okay, that makes sense. And negotiations are in train for the divestment of JN Fund Managers. The group said in its audited financials released last week. So I'm going to go to the report, see if we can find what they say about that. The transaction with BCIC awaits regulatory approval, right? So these things take some time, right? JN Fund Managers operates a brokerage and wealth management firm. JNGI insures vehicles and properties. So they recorded a loss of $2.5 billion for the year ending March 2024, according to the audited financials signed on January 27th and released last week, right? At a significant loss, right? So it mirrored losses of $2.5 billion a year earlier and was exponentially greater than the $165 million losses in 2022. So they went from 165, 2.5 billion, 2.5 billion. So over 5 billion in losses over the last 3 years. And prior to that, the group made a profit of 6.5 billion in 2021 and 619 million in 2020, right? So they went from being profitable, making 6.5 billion in profit in 2021, right? Notwithstanding the bleed in 2024, the company's cash position was resilient, having grown from 16 billion to 60 billion, probably from the sale of some of its assets. I'm imagining that's why the cash would have been built up. So they sold 80% stake in Jane Bank UK for a consideration of £20 million. That's roughly 3.9 billion, but the fair value was determined to be 25 million. It resulted in an accounting loss of the sale to Step One Money UK Limited, an unrelated company, and then this transfer resulted in a change in an immediate parent from JN Financial Group to Step One Money UK Limited, JN said, and so on and so forth. All right, so I'll pause there. Let me just probably pin some of these questions here because I know there'll probably be a lot to go through. All right, so Chris, I see a question about NCB. We'll get there. Limitless, there's no Michael Leaching interview. I can tell you that from now. There's none scheduled. We'll get back to these. I'm just bookmarking these questions so that I don't lose track of them. Okay. All right, so Unbothered, I see that you say use Jane Fund Managers as your broker. You say used, so you don't use them anymore? Is it that you closed your account or removed your account? Let me know. All right. So it says here, Jane's financial assets are closely matched against its liabilities, with the gap narrowing in the financial year. So specifically, capital as a percentage of total assets dipped 11% in March 2023 to 8.7% in 2024. That translated to 31 billion in capital on 364 billion in assets, right? So revenue grew in the year, but so too expenses. So net interest revenue after impairment losses totaled 11.7 billion, right? We'll talk about that stuff if we have time later, which was 9% higher than the 10.7% than the 10.7 billion that was reported a year earlier, but the gains were erased by bigger expenses, resulting in a net loss, right? So essentially, they've been feeling it, right? The losses came amid a booming real estate market. I have my thoughts as to whether or not it's actually booming, but that's for another day. Where housing prices increased significantly over the past 5 years. Jane, for its part, increased the number of client accounts to over 91,000 from 78,000 a year earlier. And this is why, so, I mean, increasing the number of clients doesn't necessarily mean that there is a direct correlation to how much money the bank will make, because I'm assuming of these, 13,000 accounts, maybe not all of them are taking out loans, because of course the bank doesn't really make money when you just have a savings account. You need to take loans, whether credit cards, whether services, etc., to be able to move the needle for the bank, right? So however, this growth has not translated into profitability. That's literally what I just said. As some clients have struggled to meet mortgage payments, that's key, further straining the group's financial performance, right? So if clients can't pay, if persons are taking out 100 million in loans and those are supposed to bring interest payments of like 20 million, 30 million, but they're not able to pay it, then that's going to impact their profitability. And of course, it's going to impact their impairment losses, right? And we see this figure for companies like, for example, it's common for financial companies because there's a certain percentage that you have to kind of plan for in terms of losses, right? So we see that for companies like Dollar Financial, etc., where we're always looking at their expected credit losses and seeing how that number is being managed. So despite an increase to its loan book to 173 billion from 145 billion, they face challenges, right? So loans and advances on which interest is no longer accrued amounted to 12.4 billion, flat compared to the prior year. And from that figure, the group wrote off 3.3 billion in bad debts, right? That's significant, right? 3.3 billion in bad debts. Again, just kind of highlights the fact that within this economy, if persons can't make their payments, then the bank is not going to be able to manage from that, right? So an increase from the 101 million written off in 2023. So they went from writing off 101 million to 3.3 billion, right? That's significant, of course. And then I think this is the last paragraph. So in the current year, impairment losses for J&B Bank UK were determined by imputing fair value of the subsidiary based on the consideration of the 20 million paid by an independent third party for 80.1% interest. The fair value determined that 25 million net the carrying value of 32.9 million resulted in an impairment provision of 1.3 billion, the group reported. All right. So I know that said a lot there. We look at the financial statements and then we'll kind of talk about it some more, right? Let me pause here for some questions before. Diana, see a message. I will just send me a message. That's the best way to do it right now. Most of the people that I know, Jane, yeah, so that's true. That's true, Sean. I've seen that for Renee, because Renee had a Jane account. She had a Jane US account, and it took us really long to get our money. so we closed that account years ago. They say JN is among the worst customer service in financial companies operating. I can't speak to that because I've never had an account with them, but I will say I went to JN, I think early January, to do a transaction. I don't remember what I was there for. And I was in the bank for almost 4 hours, and I was in the line only to realize that like right before I got through, I realized that I could have done something, because I came in and told the lady at the front what I wanted to do, and she told me to join the line, only to find out later on that I could have joined another line or done like one of those drop boxes or something like that. And I was like, you could have saved me 4 hours, right? So I was very annoyed at that for sure. Real estate is not booming at all. So here's the thing, Christopher, and I'll do a video on this for sure, because I think there's been a lot of investments in real estate, right? And based on how real estate works, because so you can buy a property now for 5 million, and because of how the market works, next year you can see that 5 million you've spent is valued at 10 million, right? But that's not cash, right? That's just I guess we call it unrealized gains, but it's not liquidity at all, right? So you may have a company that spends 50 million or 100 million to build some properties, right? It probably costs a lot more than that. And so when they spend that money for the properties can now be valued after a year or two, maybe 2 or 3 times what they've spent. The land is going to increase in value, etc. But maybe they have to take out some loan or mortgage to finance a project. Then you have the persons who are purchasing the units now after they've built it, who have to take loans and mortgages to purchase the home. And then now they're hoping to be able to sell to somebody or rent to somebody else to pay for those properties, right? So if you notice that so the developers taking a loan, the persons who are buying or renting are taking a loan. And so this whole lot of sort of revenue is created depending on who is lending them the money, etc. But that doesn't necessarily mean, for example, all the units are going to be rented. It doesn't mean that it turns out to be a profitable investment for those who are purchasing the properties, right? Because I shared with you guys already that we exited our real estate transaction because it wasn't generating positive cash for us, right? So we were paying maybe I think 150,000 per month for an apartment we had, and we couldn't rent it for more than 95 or 100,000. So we're losing 50,000 in cash every month, and we had a lot of repairs, a lot of things that we had to be maintaining as well. So we, after I think a little under 2 years, we're like, this is not worth it. We're spending too much cash. It is not. I mean, the good thing for us, the property value increased. We're able to make a profit on the transaction, but the real profit, right? Because there's a profit of the transaction, and then we looked at our real profit between the months we couldn't get it rented, the months we made losses. So that profit was a lot less because of just how everything went down, right? I won't get back into that. It was traumatic for me for sure, right? What really constitutes a booming real estate market? I don't know. Giovanni is saying that's a lot of bad debt. Maybe they need to review their loan requirements. No, so it's impacting all of the banks, right? And that's why I'm saying that I'm worried, right? That's why the title of this video says I'm worried, right? Because what's happening to them is not unique to them, right? JN is not the only bank where clients are struggling to make loan payments, right? That's something that's going to be impacting the entire industry, right? Exactly, Sean. So the high interest rate environment is really pressuring for them, because if you and I can't make payments, right? So think about it this way again. As you and I, our salaries have not been increasing, right? So from our salaries, we pay our monthly expenses. One of our monthly expenses is the loans. If we have increasing costs on our side, the mortgage is one of the areas that we may not be able to pay comfortably. If we can't pay it, again, that's where the bank makes their money, right? So Kayla Moore, you're not late. You're not late. I haven't started my rant yet. Okay. Tavares, I have not looked at energy yet, but I'm planning to. I'm planning to look at Wigton, and I'm planning to look at energy, because I have some thoughts for sure that I want to share. Save that. Christopher says a lot of apartments you see are also vacant as rental prices are extremely high. This is what I'm saying. This is what I'm saying. This is what I'm saying. OJ is saying, but no buyer to. You guys are getting it. You guys are getting it. Shells, I don't know why I did it. I don't know why I did it. Don't know why I did it. Dacian, thank you for thanking me before I'm even finished with the video. I appreciate you. All right. So let's go to their annual report. Is it annual report? Let me see. Guys, don't even get me start talking about the pensions. Asimo mentioning about pension, please. I definitely start ranting if we talk about pensions here. The customer service and wait time is horrible. I waited 3 hours just to be told I had to bring back a document. I'm sorry to be laughing at you, by the way. Went back the next day and waited 3 hours again. I was told that was the average wait time. Okay. Okay. All right. So I typically don't like to bash at all. That's not my style. So I'll try not to do that. So Sean is saying, do you think this is in relation to a slowing real estate market due to high interest rates? One of the factors for sure is that. That's one of the factors for sure. All right. So I am going to go through the financials for JN Financial Group now. So I'm going to warn you, those who are scarred by math, maybe you had some trauma with math in high school or even university, it's going to be okay. You can make it through. Just don't get lost. All right. So I'm going to go straight to their profit and loss. Or do I want to read their audit report? Let me see. Okay, let me go straight to there. The entire report is 192 pages, right? So you guys would have to give me like a whole 2-3 hours to read through all of this, right? So we're gonna go to I'm gonna look at the balance sheet briefly, right? I'm just queuing it up, so that's why you're not seeing anything yet. Hey Greg, good to see you. Greg is saying banking is a highly regulated sector. Market conditions have made it even more difficult with the high interest rates and tight liquidity conditions over the past years. Yes, right. Greg, I wish you could join me. I should have reached out to you for this episode. Let me know if you can join me backstage because, yeah, let me know. All right, so let me share my screen here again. So this is a scanned copy, it looks like. So I'm gonna try to keep it viewable. Okay, all right. So just a quick overview here for those who have never seen one of these before. This is a statement of financial position, also known as a balance sheet for the company. So think about it as showing the net worth of the company. So just like you have your personal net worth, your assets, your liabilities, and so on, the companies have that as well, right? So you have many different classifications of assets, you have many different classifications of liabilities, and we look at that to kind of get an idea as to where a company is in terms of its financial position, right? So we're just going to do a high level. We can't really dig deep into everything, and of course, this is me just looking at the numbers. I'm not sure how much detail is in the report, so I'll see what we can garner from it in terms of context. Usually there's an MD&A or some write-up of some kind that we'll be able to go through, and hopefully that will give us some context that just the raw numbers may not be able to give us. And note, we're only looking at the last 2 years. We're not doing like a 5-year analysis or anything like that. So just bear that in mind. All right. So it says here cash resources at 77 billion. Now all of these are quoted in thousands. So when you see million, it's really saying billion. All right. So 77 billion in cash resources. The article did mention that growth from last year for sure. And terms of investments would have, the bank has investments of 82 billion. That's down from the year before. Loans after allowance for impairment losses, right? So we saw the 173 billion, right? So Sean, it's JN Financial Group, not just the bank, it's a financial, JN Financial Group, all right? And then we have, so the loans, of course, will be the total amount that they have to clients, right? And it says after allowance for impairment losses, because you have to have that context, of course, right? Property and equipment is 4.9 billion, goodwill and other intangible assets. So their total assets here, 364 billion. It's actually gone up. And I'm sorry if you can't see this, by the way. I'll try and share a link in the description to this if you want to be able to check it out. But just do a Google search for JN Financial Annual Report, and you should find it pretty quickly. All right. So customer deposits have actually increased here. So customer deposits 268 billion, up from 202. And of course, that's not necessarily surprising to me. I did see an article that mentioned that deposits as a whole have actually increased at financial institutions. So more persons are saving essentially than actually investing that money. And it has securities sold here on the repurchase agreements. Other payables, so payables would be money that the bank owes. So that's 6.5 billion. And margin loans payable, let me just scroll through for anything significant here. Share capital, retained earnings. So their retained earnings is down from the previous year. So from 10 billion to 7 billion here. Usually you want to see retained earnings increasing. So decreasing means they made a loss. All right, so that's your balance sheet, 364 billion in assets. And I think the financials, let me go to the profit and loss, because that's, I think, where we want to focus on. Is this one it? Okay, I think that's it. All right, let me check to see if anybody's sending me any messages as well. I know sometimes persons will message to give me some context while I'm actually doing the live. So let me see if anybody's doing that. Let me see here. See if anybody's messaging me. Okay. Okay. Yeah, man, no problem. I see your message, guys. Somebody did message me and say my camera is blurry. I don't think it is. All right. So we'll go through their statement of profit or loss. So this is where we look at whether or not they made a profit or a loss. And of course, it's showing you here that you have the group level and then the company level. And so we'll focus on the group for the purposes of what we're going through here. All right. So of course, revenue for banks is interest on loans or interest on investments here. So that's what you're seeing here for this one. So interest on loans. So when the bank lends you money, that's income for them, right? The interest that they get from you is their income, right? So it's similar for financial institutions. And interest on their investments. So when they have investments just like you, they get interest, and that's income for them. So that is about 21 billion. And then of course you have interest expense, because there. So think of that almost like a cost of goods sold. If I'm speaking out of turn at any point, Greg or anybody else, you can let me know. And we see net interest income. So this would be the net for them both. So 14 billion as opposed to 13 billion the year before. So that's a marginal increase there. And then you have impairment losses. So impairment losses stood at about 2.8 billion. And then you have net interest income after expected credit losses. So I probably need to do a video like explaining some of these terms and going through what these things mean, how they're calculated, etc. That may come at a later date, right? And so it says here, net financial results, 11.9 billion. And then you have other revenue, right? So sometimes there may have other lines of revenue that come in. So that's what they're showing here. So insurance revenue actually increased for them. And I mean, everybody's feeling it in terms of insurance premiums, I'm sure. So it's not surprising that revenue has gone up for them. Insurance service expenses have gone up by almost $1 billion here. And so, of course, net insurance revenue is actually negative. So 618 million and up from 625 million there. And so, let me see here. Other operating income is 10.2 billion. That's slightly up. And then you have finance costs here, loss on loan payable, modification. So a lot of terms here that I'm sorry, guys, for those who are new, you may not understand all of this stuff here. Loss before taxation is 3.3 billion here, up from 1.9 billion, well, down from the year before. And then taxation is that number, and then you have the loss for the 2.5 billion, right? So it's pretty much the same as I had the year before here. So the operating expenses seem to have risen by 2 billion, right? So 22 here, 24 here, so maybe 2.6 or 2.7 billion more, right? So the operating expenses is where most of the losses would have come from for the year that we're looking at. So we'll have to look at note 37 to see what the details are. I'm probably going to do that, so I'll try to find that shortly and see. All right, so node 37 is where I'll find, yeah, so let me just try and find that here. 1 second, I'm not gonna have you watch me scrolling. So let me just search for it and bring it up. And as I said, guys, let me know if you have any questions, and I'm going to not make this any more technical than it needs to be. So if you have questions, let me know, and we'll get to talking about some of the other financial companies as well, because that's really what I wanted to do. I didn't want this to become a stock review. Well, they're not a listed company, but I didn't want to get too technical because I know that there are some persons who are new who may not understand some of this. So I wanted to keep it simple. All right, so need to find note 37. Okay, so I think I found it. I hear David Rose saying to me, just search. As usually I'm scrolling and David would say to me, Jermaine, just search for it. So that's what I did. David would be proud of me, right? Okay, so I found it. Let's share again. So note 37 spoke about their expenses, right? So the first one we see here, administrative expenses, over $1 billion more, right? So 1.2 billion more, right? So Mike Kelly saying the same thing, that my camera is out of focus. That's normal. Let me probably turn it off and turn it on, and I probably will take care of that. That happens, right? So employee costs, that's note 39. So we have administrative expenses which have gone up, employee costs which have gone up as well. Advertising and promotion is pretty much the same. This amount, bad debts written off for loans and other receivables, right? That's over 200 million, 260 million here that they've written off, right? That's a big deal. And we have here depreciation, that's of course an unavoidable expense. Legal and other professional fees, so all fees like costs for employees, costs for contractors, all of those have gone up over the last few years, right? And companies are under significant pressure to be paying more, right? So all of the services that they have to pay for probably cost them more, right? So legal and other professional fees have gone up. Insurance claims have also gone up, right? Insurance claims and benefits are up 500 million. So we see here 30 billion as opposed to 27, right? So that's that line 37 that we're looking at here. And so I'm going to leave it there for now, but I'm going to see if there is some sort of MD&A or something to give us some context on the financials. I don't know if they would have that. So I'm just going to do a quick search. If I don't see it, then we'll just stop here because there's no page of contents really. Just give me one more second. Let me just search if there's management discussion. I don't know if they would have this. Nope, I don't see that. Search for analysis. I don't know if they have that, right? And I don't want to spend the day searching for it. All right. Okay. All right. So let's talk about the other financial companies now, which I know some of you have been waiting on, right? So what my thoughts are, right, is that the way that you know that, so what I alluded to in the start, let me say it this way. What I alluded to in the start is the company that I was referring to. When the pandemic came, I had quite a bit of financial stocks in my portfolio, right? Because before the pandemic, the financial stocks were doing well, right? The NCBs, JMMB, VM, just think about any one of them, they were probably doing really well, right? And so when the pandemic came, those stocks kind of made some some serious nosedives, right? And then some of them recovered slightly, and then they started to kind of creep their way back down, right? This has been happening for a while. And what happened was the high interest rates didn't really help things, right? Because the interest rates is not just on our side. The banks also have to pay a higher rate when they borrow money from the central bank, etc. And everything in general is actually of a higher cost now, right? So admin expenses across the board have gone up. We've seen companies have just higher payrolls, so the cost of talent is more, right? So persons who are like professionals in their fields, who are maybe having certain roles, it costs more to keep them. So companies are required to give more benefits, more things to keep employees engaged, more like in terms of their benefits package as well. All of that stuff is impacting the financial institution. And with a combination of things like that, so at first it would be, I would say, the immediate impact would have been on the consumer side, right? So if more businesses are struggling, then they would require more loans. If I take a loan to help my business and then my business doesn't improve, I'm going to be at risk of not paying that loan, right? And on its simplest level, banks make money from interest income. So if I take $10 million from the bank in a loan, it looks great that the bank has lent me $10 million, but if I can't make that payment, it's the bank eventually has to write off that debt. And then now where it would have made 10 million plus interest, it's now at risk of either losing that money altogether. Sure, it can recover some by maybe selling that asset that they have as collateral for me, but they may not be able to recover everything, right? So it's been an impact on that side because on me, again, on the personal level, if I'm now juggling my mortgage and I can't pay it, juggling my car loan and I can't pay it, juggling higher school fee for my kids, Digicel increases their bill like every year. Like I said this last year that, so where I'm living now, I took out Digicel internet in 2016. Every single year that internet bill has gone up since I've been here. I think when I just moved here, I was paying maybe $4,000 or $3,000 high. I'm now paying almost $9,000 per month. So every year it goes up by almost 10%, right? And it's been every year it goes up. So it costs me more, and my salary, for example, is not going up by 10% every year. So all of that puts a strain on the financial institution. Jovan, don't even get me started about my light bill. My light bill now, for some of you, this may be high, some of you, this may be low. When I had my apartment, we were paying $4,000, $5,000 for light bill. We're paying like 10 times that right now, right? So it's all of that is up. So now I'm not as, so for example, we've been kind of limiting our credit, limiting our loans, limiting the things that would normally take from the bank. We haven't taken a new car loan in over 5 years, things like that. So that means the banks aren't going to be generating as much revenue, right? And then, of course, we know that some of the financial institutions, due to, I think, the change in IFRS reporting, some of them would have to change how certain revenues are expressed in terms of their financials, which means that had an impact to them as well, right? So it's been a major thing, right? And that's why I think overall the financial sector will not recover until the entire country recovers, because when you and I are, when it feels better for you, it will likely be better for the bank. If it doesn't feel better for you, it's not likely going to be better for the bank. So whereas we saw where NCB, for example, reduced their headcount to be able to kind of squeeze out some profits, right? So essentially, downsizing, and companies can do that, right? They have the right to do that. At some point now, I think that will only take you so far unless the overall country recovers, right? So let's start going through some of the financial companies. can't believe it's 45 minutes already. So let me go through. Just I look at NCB, and we'll start there, right? So Sean is saying, what if the financial sector doesn't recover? What does that mean? So the financial sector specifically, I think it's so the financial sector is driven by the success of its consumers, right? Because remember, they're making money based on it. So if things aren't better for you, Sean, you're not likely to take a loan. And that's just kind of, you're not going to consume more if things aren't better for you. So things have to be better for you for it to be better for the financial institutions, even on a business level. Because if I take a business loan to grow my business, but my clients aren't spending more, I'm going to have trouble repaying that business loan. It's still going to impact the bank in that way as well. All right. So Giovanni is saying workforce reduction should really be the last resort. It depends, honestly, because as a business owner, it's your largest expense. So I wouldn't say it should be the last resort, honestly. I know it feels hard if you are an employee to lose your job, but at the same time, from the company perspective, no, I'm not saying that you let go employees first or anything like that, but salaries and admin expenses are usually the largest line item. And what I mean by that is it's the greatest opportunity to see immediate results, right? Because from an investor perspective, we're looking at, is the company more profitable? Because as an investor, we want dividends. We want to see the company do really well compared to the previous year, so that new investors are inclined to come in. Those new investors come in, we see our cap gains on our investment. So from a moral perspective, we may want to see companies keep their employees as long as possible. But from an investment perspective, if we want dividends, the company has to find that money somewhere. And unfortunately, companies do go for that first, because it's, again, as I said, you can see immediate impact that way. And SE is saying, unfortunately, will always be the first. And we see it in the US all the time. So companies in the US are, I mean, it's this running joke. The tech companies will hire hundreds of people every year and lay off hundreds of people every year. It makes no sense to me, but it's like this cycle, right? All right, so let me see if I missed any question here. Okay, so let's look at NCB, because I know some people have been waiting to go through that. So let me know the financial stocks you want me to look at. And I'm gonna focus on main market here, guys. It'd be just simpler for now. So let me see. Financial institutions are directly related to consumer power. The more money persons have to spend in order to pay back loans, the better the financial institutions will perform. Exactly, right? So it's all related in that way, because the interest income is going to be the largest line item in most cases. Now, there are other services that banks can provide, right? Like you have insurance, remittances, etc., etc. But the interest income from loans is likely always going to be the largest line item, I believe. Now, I may be wrong, but yeah. All right, so last F is junior market, VMIL. Okay, so let me go with VMIL, because I think I started to look at NCB the other day, right? But VMIL, I do remember this company specifically, because this was the first stock that I bought on the Jamaica Stock Exchange, VMIL. And the IPO, when we bought it, was $2.33 in 2017, right? So 2017 till now, 8 years, it's gone, I believe, 500% up. I think it went to $13, and now it's back down to $2.39, right? That's a big deal. That's a big deal, right? So let me check something here real quick. So we're going to look at VMIL a little bit here. Okay. So let me see what somebody's asking for here. Tiffany, I'm not sure we can look at the Mayberry bond right now. So I will be looking at bonds, but not right now. I feel like we kind of talked about that a little bit when we did the investment challenge. So Tiffany, sorry, I won't be covering that tonight. I will be talking about QWI if I have time. And so that's the VMIL, that's the NCB, and the Sagicor. Okay, we'll get to them. GMMB. Okay, so I'll start with VMIL and work my way through. All right. So this is VMIL years, and you see 5 years ago, this February 2020, this was $9.96. Right, so it's gone down 65% over the last 5 years. Right, that's one. JMMB. I'm just looking at, for example, how the prices have gone in 5 years, right? So this is down 41%. That's JMMB over the last 5 years. Let me see here. NCBFG. 5 years, it's down 70% in the last 5 years. So 5 years ago, it was $185, and now it's below 50. Let me see, Sagicor Financial? I'm not, this doesn't look like, is it SJ, guys? Or is it SGJ? I can never remember. I'm always mixing up Sagicor and Scotia. Okay, Sagicor Group. Okay, so Sagicor Group here, 5 years down 20%, right? So this has actually fallen the least. So $68, and now it's slightly over 40. I think Scotia now is SGJ. There we go. I finally get it. So Scotia, wow, Scotia has grown in the last 5 years, right? So 20%. So Scotia is the only one that has grown in the last 5 years. Who else is there? Did we do JMMB already? Yes, we looked at JMMB already. Who else is there? Am I missing anybody? So that's interesting, right? Scotia is the only one. QWI is not a financial stock, but let's see how are they a financial stock? No, I don't really consider them such, but they've grown in the last 5 years as well. Okay, all right. So let's start with VMIL first. So we are seeing here from that I just showed that most of the financial stocks, Scotia is the only one that has grown in the last 5 years. Okay, yeah, Barita. I think Barita has Barita grown? Maybe they went down last 5 years. Oh, wow. So Barita has grown in the last 5 years as well, 30%, right? So that's actually higher than Scotia. Don't know about Proven, but let's see. Proven Group. 5 years down almost 50%, right? So what, two financial companies over the last 5 years have actually grown, right? Barita and Scotia, right? So I'm actually going to try to do a kind of breakdown of all of them. I just need time to put the data together. So if somebody has the data, feel free to send it to me. But kind of comparing revenues, profits, stock price over the last 5 years for these financial stocks. It just takes some time to put everything together, right? Does it take into consideration stock splits? Does it? Let me check which company has split over the last 5 years. We can check that. It should though. I don't see why. So this platform ticker works off the Bloomberg terminal. So that's why I use them, because I know that the JC data is there. Now there are some things of it that does not update often, and I'm just using the basic plan here. I'm not using the paid plan. All right. So let's start with VMIL. So we look at just two companies. We look at one that has not been growing. So VMIL, I think, has had some significant losses in terms of stock price. And then we look at a company like Scotia that has been profitable. All right, that has grown in stock price. All right. Cygnus. Okay, yeah, we can look at Cygnus as well. All right, so quarterly financials, or do I want to look at annual reports? Because I want to see how far back we can go. Why am I only seeing 2021 here? So, boy. Annual reports for VMIL. So I'm just looking for their annual report. Why am I not seeing a 2023 annual report? All right, hold on. Let me just do a search again. All right, good to see all you guys here on a Friday night. VMIL annual report. So I'm seeing 2023 annual reports. That was June 2024. Okay, so 2024 has not come out yet. All right. All right, so this is their 2023 annual report. We're going to go straight to the numbers, guys. We want to see the last 5 years. So usually there's like a 5-year summary. That's what we're going for. This is balance sheet, income statement. Okay. All right, so we're going to focus first on income. And I apologize in advance if for those viewing on mobile, you may not be able to see my screen. All right, so the middle here is 2019. Okay, so let me focus. So fourth column is 2020. And I really don't like when the reports are designed this way because it's going to be hard for you to see. All right, so the fourth column is 2020, right? So net interest income actually went up for that year, went up for 2021, and then went down for 2022. And look at that number for 2023, right? That is a significant drop, to say the least, right? So 369, I'm assuming this is million. Does it show I'm assuming this is million, right? Because it can't be thousand, right? So I'm going to assume that this is million, right? So from 369 million to 47 million, right? In interest income, fees and commissions from 925 million to 944. So that's gone up slightly there. Gains from investment activities have gone up there, 593 to 866. Staff costs, which is certainly one of the things I want to look at, 587 million. So is this million? Staff costs can't be that much. Or is this in US? I need to check, right? Because I'm assuming that this is million. But staff costs being 912 almost seems like ridiculously high. Let me see if I can find out. This must be millions I'm looking at, right? Well, let me just do a comparison here. Yeah, because it can't be thousands, right? So I'm assuming it's million, but or is it would I do it in USD? I don't know. I'm gonna check, right? Because I'm like that's crazy. But net profit here, right? 433,000 in terms of the units that we're seeing here to 198, right? So that's more than a 50% drop in net profit, right? So they made a recovery here for 2022. So I don't know What would have led to that? I don't know if yeah, because yeah, I'd have to go into that to see. All right, but the 2023 for them was certainly not good at all, and so I mean, I'm assuming it's million, right? So that's their these are their ratios. This should hopefully, does it show stock price? I want to maybe track stock price, closing share price. Okay, so closing share price from 2021 here. So we went from, is it share price here? I am closing share. Okay, like what's wrong with me? So closing share price $5.90 in 2020, down to $2.75. So you saw where I think this one was where that year it went up to the $13. It must be millions. That's what I'm thinking as well. So you see in the share price how it went down. Dividends per share. I remember we used to get dividends for that company when we owned it. Haven't seen that. Well, I haven't had it in years. But you saw the dividend go down 3 cents for 2020, then 16, then 0. Did they pay a dividend last year? 0, right? Of course, you're not able to pay a dividend if you're not able to have a certain amount of profit. So there's that. And all right. I'm not sure why these graphs are so small as well. Okay, so that is VMIL. Next, I said let's look at Scotia, right? Because we saw Scotia went up. So I certainly will need to analyze these a lot better. So I probably need to do a stock review to give these justice. But Scotia was one of them that we saw has gone up 20% in the last 5 years. So let's look at annual report for them. They paid a dividend. Yes, I could have. Yeah, I think L.E.A.R.N is still holding from IPO. Is that what you're saying? So you said you got a dividend last November. Is that what you're saying? Are you a shareholder? Are you a believer? All right. Scotia here, 2024 annual report. Okay. All right. Scotia Group. This is AGM. Oh, I clicked on AGM, not annual report. Annual report here, 2021. So you see here, it shouldn't be 2021 report. That's why I had to search for it last time. Scotia Group Jamaica annual report. So going straight to the financials, I do not know why they have these numbers so hard for you to see. Okay, at least these are closer to the front so we can read that a little better. Total assets have gone up, performing loans have gone up, non-performing loans have gone up here. Deposits by the public is the most in the last 3 years. Stockholders' equity have gone up. Net profit has gone from, I'm assuming this is millions, and not, is it billions or billions? Okay, so this is in thousands, so this is billions. Okay, so 17 billion in profit for 2023. Dividends paid, always love to see dividends paid. And number of stock units at the end of the year, it's been the same there. Earnings per share has gone up, so you always want to see earnings per share go up. Yes, I've seen that, Georgia, where I've heard that Scotia pays consistent dividends. I've always been, I must say, I haven't always had, I think, a fair view of Scotia until recently, meaning there's a public perception of Scotia that I would say I bought into, but I've learned to kind of give them a fair assessment over the years, right? So dividends per stock unit $1.40. So this would be less than NCB's. NCB's pay is I think 50 cents per quarter. So that's $2. Dividend yield 4%. No comment on that one in this video. And so we looked at so their net profit has actually gone up significantly, right? So from 8 billion, 10 billion, 17 billion. So they have been as in growing over the past 3 years, right? So that's awesome to see. Profit before taxation has gone up as well. So okay, all right, cool. So did I say I would look at anyone else? So I don't know how to pronounce your name, VW. For Sagicor Select F, that's going to perform based on the financial companies. And since all of them aren't doing well, it's no surprise that Sagicor Select F is not doing well. All right, so bear that in mind. All right. Lavine say, I hope it's millions, because if it's thousands, I'm in trouble. You would be in trouble for sure. RPL is not a financial stock, Chris. Palace has had a stock split. Yeah, I know. So I'll check that later on. All right. QWI is an ETF. Kind of. All right. So let me see here. I'm just looking to see if anyone has any questions that I'm missing. Okay. All right. So let's kind of close things off here, right? Because I like the videos for about an hour here. So what I'll say is that I just think that for the so we started by looking at JN Financial Group, and as I said, though they aren't listed, it's giving you a clue as to how the industry itself on a whole has performed, right? So when I say I'm worried about the financial stocks and the financial sector, is that until we have we don't know when we're going to recover. So interest rates going down is a positive sign, but it's not an automatic sign of recovery. Let me say it that way, because ultimately there has to be a way for us to start growing again as a country. Because if things don't get better for us personally, then it's not going to be better for the country, and it's not going to be better for the financial institutions. Now, I do believe that there are industries that will thrive in this economy that we're in right now, one of which are companies that can generate enough cash to pay a dividends, right? So that's a simple one. I do have other industries that I believe will do well. I'm not going to cover them here now, but that's one example that we saw where on the stock market specifically, companies that are able to pay a healthy dividend. So maybe that's why also Scotia has been growing, because they've been growing their profits. They've been consistently paying their dividends. So their shareholders are likely just continually confident about the state of the company, etc. Right? Haven't done a full stock review on them, but just what the last 3 years have shown us for them in terms of their financials. It's a good sign for sure. Right. So Sean, when Andrew Holness says that the economy is in the best shape it's ever been, that's always within context, right? That's always within context. So bear that in mind. Sagicor Select F was heavily invested in NCB, and NCB dropped from $235, Georgia, $235 to $50, right? And how much impact do I think companies such as GK, which is almost a one-stop shop, have on financial institutions? When you say impact, I'm not sure what you mean. So GK has a financial sector as well. But do we see those numbers? I don't know if we see that in GK's overall report. I'd have to look at that. Could it be that Scotia only grows because it's the challenges NCB has been facing public? I don't think so. I don't think so. Not just that. Jovan says Andrew is selling unicorn. I don't agree. I actually believe that as a country, so it's not easy to lead a country during a difficult time. So remember, the pandemic has been difficult for everybody, and certainly I have high praise for the work that Dr. Nigel Clark has done. And there's never going to be, I believe, a perfect government, right? So I'm not saying I think one side is better or anything like that. That's not my stance. But I do think that it's difficult to lead a country through a difficult time, right? Because when you manage a country, there's a lot of moving parts, a lot of things to consider. So I wouldn't say selling unicorns. I haven't heard anything that sounds, ridiculous or unbelievable or hard to imagine. So we'll definitely be talking about the budget this year for sure. So we'll see when that comes out, right? Levine says, seen NCB prices have me traumatized about the possible trauma I barely missed if I had held on. Yeah, so I sold, my average price for NCB was $180. In July 2021, I sold at about 150, right? So I took 15-16% loss. It was a significant loss for me. But when I sold, I put that money into Fesco. And so Fesco did really well, of course. I think my average price at the time was like $2.30 or something. I don't remember fully. And that went up almost to $7. $7.11 is when I sold. It went up over $8, right? So you just have to know when. So as I said, I looked and saw that the performance of the economy was so closely correlated to the performance of the financial stocks that I thought I didn't see where it made sense to keep those in my portfolio during those rough years. Certainly we weren't back outside yet. Certainly we didn't have any clarity around when the pandemic would end or anything like that. So it didn't make sense to me to hold on to. So I had a lot of financial stocks in my portfolio, from VM to JMMB, to NCB. I had a couple of them, right? Because again, those were the stocks that were doing really well before the pandemic. And so when I just decided to take a loss early, right? So I'm happy I didn't wait too long, right? Because when you're taking a loss, and this is not something I'm going to cover in this forum, but when you're taking a loss, the best thing that you can do is decide to take the loss early. If you wait too long, the losses are going to be more, right? Okay. So default name outside of the market reaction to the stock price is what metric you'd say you'd use in the analysis to say they declined. Loan bookings would naturally decline, but what about unconditional from others? So I'll try to answer what I think you're asking. So the market reaction to so look at it this way, default name. The initial market reaction to stock prices overall, not just financial companies, was based on the pandemic. So uncertainty in the economy is going to lead to uncertainty in the stock market. Confidence in the stock market is typically going to be based on confidence in the economy. So the two are always related, right? So the stock price is a function of investors' optimism, right? That's all it is. Because remember, you're investing for the future. You hold companies in your portfolio that you expect are going to be more profitable, who are going to be growing, who are going to be paying more dividends, etc. So when investors see a company that they expect are going to continue to grow, are going to continue to pay dividends, are going to continue to break records, it makes them optimistic about the future of that company. And so investors want to buy more shares, right? That's the simplest way to put it. So what I look for specifically for financial companies is income. I'm looking at revenues because that's the first line, right? That's let me know how they're trending. Next, I'm looking at their expenses, right? How are they able to manage that? Are they consolidating? How are they selling off subsidiaries or downsizing staff to manage expenses? And are they able to now consistently grow their profits? Because of course I'm going to be watching closely for dividends, right? So at a higher level, those are the things that I'm looking at. All of the other areas that are nice to know, their statement of financial position in terms of their balance sheet. It's always good to know the financial health of the company. Always good to know their plans for growth. Always good to know how they're managing in terms of like efficiencies, etc. But it's really a simple analysis for me, because financial institutions are going to be very closely tied to the state of the economy, right? So you do have to do a lot of in-depth analysis to really see. Now, when you do choose, so let's say that you want to choose a company to invest in, you certainly want to do deep analysis to know how solid the company is if you're going to put your hard-earned money in it. But hopefully that answers your question. Last part should read other form of revenues, FX investment, etc. Okay, thank you, sir. Or ma'am, I don't know. So hopefully, let me know if I answered the question for you, because that's really how I'm looking at it. That's kind of how my brain works. I'm looking at companies, right? I'm looking at the business side of it. I'm looking at what's happening day to day for that company, right? So I'm not, it's not going to be more complex than that for me, because the state of something is going to tell me how that company is going to be down the line, right? And I'm going to be talking about in another video the impact of the tariffs that Trump may be imposing and some of the other things, because that will have an impact, whether directly or indirectly, for some of the companies in our portfolios. All right. So I think I'm going to end it there for tonight. I am going to jump over to our community group for a few minutes. There's something that I want to talk about over there briefly. So if you want to join us over there, you can. The link is in the description of this video over on YouTube for you to join me over there. And so I do want to talk about Massey Solomon. Oh, thank you for reminding me. I do want to talk about Massey. I want to talk about Trinity. There are so many things I want to talk about. I feel like I want to go live every day and talk about. You guys need to just give me. I did a forecast of how much it would take for us to start doing like content every day. It was like $20 million we needed, and we'd be able to do like content around the clock. And one day, right? Last comment I'll read here. An high interest rate environment is challenging for growth, except for savers. Are you sure about that, sir? As rates reduce and cheap liquidity returns, things get better. Okay, Mo. I won't touch that for now. Carrick says, we support going live most days. Every day is tiring. It's tiring for me too. I'm tired too. I was taking a nap right before this live. I set the live for 7 o'clock and I could not move. And so I asked Renee to change it to 7:15 because I did not want to come out of my bed. But yeah. Okay, guys, so I'm gonna go over the community group for a few minutes. It's 8:34. I'm gonna go over the community group until about 9 o'clock, answer some questions and kind of talk, just kind of continue the conversation. All right, so guys, look out for, I forgot to say this. I'm hoping to be able to bring to you a very, very, very wonderful interview coming up soon. I can't say who it is, but you certainly want to subscribe. You certainly want to turn on notifications because in February, I may have a treat for you. That's all I'll say for now. But I'll see you later, guys.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at L.E.A.R.N Grow Invest.